Let's talk about debits and credits. While they sound simple, they have a specific meaning in accounting that's important for understanding the big picture of a company's financials. Today, we're going to break down the basics of how debits and credits work and why they matter to the financial health of a business. At the heart of accounting is a fundamental equation. Assets equal liabilities and equity. You can think of it as a way of showing what the company owns and how it's financed. The left side, assets, represents everything valuable the company owns, like cash, equipment, and buildings. On the right side, liabilities and equity represent how the company paid for these assets, either by borrowing, liabilities, or through the company's own resources, equity. This equation always has to balance, and understanding credits and debits will help us see why. Normally, we think of a debit as a negative. I take out my debit card to buy that thing I want, and my account goes down. And credit as a positive. I got my paycheck and bingo, I have money in my account. For a company, that isn't true. Every time a company makes a transaction, we record it as either a debit or a credit, depending on how it affects the company's accounts. Think of debits and credits as a means to track money moving in and out of different parts of the company's financial picture. Debits increase assets and decrease liabilities and equity, while credits decrease assets and increase liabilities and equity. Remember, when we add value to one side of the equation, we have to balance it out on the other. That's why debits and credits always come in pairs. Let's look at how debits and credits play out on the aptly named balance sheet. The balance sheet shows us the company's assets, liabilities, and equity at a given time. Debits and credits affect what goes on this sheet because each transaction moves money in or out of these categories. When you make a debit to an asset account like cash, you're increasing the company's cash. But if you credit an asset account like equipment, it decreases as you account for depreciation over time. To simplify, think of debits as adding to assets and expenses or subtracting from liabilities and equity. Think of credits as subtracting from assets and expenses or adding to liabilities and equity. Debits and credits may seem like small details, but they're the building blocks of any financial system. When you understand them, you're better equipped to interpret financial statements and see the bigger picture of a company's financial health. Remember, it all comes back to balancing that equation. Assets equals liabilities and equity. And when you master this, you've unlocked a powerful tool for understanding how businesses operate financially.